Ever wondered how the ultra-rich seem to pay so little in taxes? Most people think they're hiding money in some secret offshore account, but that's not the real story. The truth is far more creative, and it all boils down to one simple rule: never sell your assets. Let's break it down. When an average person needs cash, what do? They sell something. Maybe some stocks, a second car, or even their house. The moment that sale happens, boom, the government is right there, ready to take its cut in the form of capital gains tax. The wealthy play a completely different game. They don't sell, they borrow. Imagine you own a billion-dollar portfolio of stocks and real estate. Instead of selling a single share, you walk into a bank and say, "Hey, I'd like a loan, and I'll use my assets as collateral." The bank loves this. They see you have valuable stuff, so they're happy to lend you millions of dollars. Here's the magic part. That loan isn't income. It's debt. Since no sale took place, there's no taxable event. You get cash to live on, invest more, or buy a yacht, all while your original assets continue to grow in value. As long as your investments appreciate faster than the interest on your loan, you're winning. The risk, of course, is if your asset values plummet. The bank might call and ask for more collateral. That's why the rich are careful. They borrow a small fraction of what they're worth, leaving a massive safety cushion so they're never forced into a fire sale. Now, let's talk about real estate, because this is where the tax code gets really interesting. On paper, the government allows property owners to claim that their buildings are depreciating or losing value over time due to wear and tear. But in the real world, what's happening? That same property is likely going up in price. The tax system doesn't care about market reality. It cares about the paperwork. So, you get to claim a paper loss, which turns into a real tax deduction against your rental income. This means you can be collecting millions in rent checks while telling the tax authorities you technically made a loss for the year. It gets even better with something called a 1031 exchange. This rule lets you sell one investment property and roll the entire profit into a new, more expensive one without paying a dime in capital gains tax. As long as you do it quickly, you can repeat this process over and over, trading up from a small apartment building to a giant skyscraper, deferring taxes indefinitely. Some even take it a step further by breaking a building down into its components: the roof, the wiring, the flooring, and claiming each part depreciates on a much faster schedule. This pulls all those juicy tax deductions into the present, maximizing cash flow today. Next up is charity, but not the kind you're thinking of. The wealthy don't just write a check to their favorite cause. They create sophisticated legal structures like donor-advised funds or private foundations. They move huge chunks of their assets, stocks, art, real estate, into these entities and get a massive tax deduction right away. But they don't have to give the money away immediately. It can sit there, invested and growing, for years. They maintain control, deciding when and where the money goes. Sometimes, they even pay their own family members a salary to manage the foundation. It's like having your cake and eating it. You get the tax break of generosity while keeping your hand on the steering wheel. What about the tech billionaires? Many founders of huge companies don't take a big salary. A salary is taxed as ordinary income, which is the highest rate. Instead, their compensation is ownership stock in the company they built. Ownership isn't taxed until it's sold. So, what do they do when they need cash? You guessed it. They borrow against their shares, just like the real estate moguls. They live incredibly lavish lives without ever generating much taxable income. And when they finally do sell some stock, they're incredibly strategic about it. They use sophisticated software to track all their investments. If they have a big gain from selling one stock, they'll simultaneously sell another one. That's lost money. This practice, called tax loss harvesting, allows the loss to cancel out the gain, wiping out the tax bill. A losing investment isn't seen as a failure. It's a valuable tool, a tax shield to be deployed at the perfect moment. The rich also understand the power of legal entities. They rarely own anything in their own name. Their assets, cars, homes, investments are held by a web of LLCs, S-corps, and trusts. One company owns another, which owns another. This creates layers of separation. It not only protects them from lawsuits, but also creates opportunities for tax deductions. A vacation becomes a business trip. If you hold a board meeting there, a portion of a home becomes a home office. Every expense is scrutinized to see if it can legally reduce taxable income. Then there's the long game, legacy. Most people think about passing wealth to their kids, where it gets hit with estate taxes. The wealthy build systems to bypass this entirely. They use complex trusts designed to last for generations. Assets are placed inside these structures, and the rules are written so that the wealth flows from children to grandchildren, without ever technically being owned by any single person in a way that triggers an inheritance tax. It's not about a one-time inheritance. It's about creating a financial dynasty that lasts forever. Finally, wealth doesn't have a passport. It can live anywhere. Assets are often placed in legal jurisdictions with more favorable tax laws. This doesn't necessarily mean a shady island nation. It can be a specific U.S. state with friendly trust laws. The owner still has full control, but on paper, the wealth belongs to a separate legal entity located somewhere else. There's even a strategy where investments are wrapped inside a special type of life insurance policy. The money grows completely tax-free. No annual tax on the gains, no capital gains tax when you take it out, and often no estate tax when you pass away. It's complex and expensive to set up, but for the super rich, it's an incredibly effective way to build wealth in silence. So, you see, the big secret isn't about hiding. It's about structuring. The wealthy don't play the same game as the rest of us. They don't focus on earning income. They focus on acquiring and leveraging assets. They don't worry about their tax bill this April. They focus on designing a system where that question becomes irrelevant. They play the ownership game, and they play it to win. Thanks for watching. If you found this interesting, make sure to like, subscribe, and hit that bell icon so you don't miss our next video. See you next time.